Welcome, everyone. My name is Mark Caesar, and I am the host of the Financial Freedom Through Apartment Investing, a proud affiliate of the GOB Apartment Network of Apartment Investors. And today we have the founder of the GOB, our very own Jim Biggs, who will be doing a deep dive on passive investing. I will let Jim give us his background. Jim, the floor is yours, sir.
Well, thank you very much. I appreciate it, Mark, and all of my fellow GOB members that are in the house tonight. Um, so I am Jim Biggs. I currently reside in the far western suburbs of Chicagoland, and we have been investing in real estate for about 40 years. And I like to tell everyone that I'm 63 and I want to be a real estate investor when I grow up. And tonight, we want to talk about how you might become a real estate investor, the easiest way to become a real estate investor, which is to become a passive real estate investor, or what we commonly refer to as an LP or limited partner. And just a little bit more about the GOB network. It is something that we're very proud of, that represents um, a cadre, if you will, of common-minded folks that are trying to make a better place for multifamily investing, both for general partners, limited partners, key principals, trying to bring all of those pieces together for people and help them overcome whatever obstacles that are preventing them from becoming investors, and no matter where they fall on that spectrum. So, Mark, I don't know if I have screen sharing ability, or if you want me to jump right in, or if you want to have a Q&A session first. What do you
Uh,
want to do?
we can have a Q&A session towards the latter end. I just gave you screen sharing capabilities.
Fantastic.
If you guys have any questions, feel free to drop them in the chat. But for the sake of time, we just want to let Jim go through his presentation, and you can ask all your questions towards the latter end.
Okay, let me know if you can see the GOB network slide.
Yes.
Yes, you're
All
good
right,
on my end.
fantastic. So let me move this screen out of my way so I can see what I'm doing here. So first off, I want to thank one of our GOB members, Vinky Lumba, for putting this together for me. She knows that I am absolutely horrible when it comes to anything artistic or tech related. So she helped me with the slides. And so we want to just jump right into why passive investing. So most of the people that are on the call tonight have an interest in real estate, or they wouldn't be here. The vast majority of us have become members of various meetups, members of various RIAs, and have been on Bigger Pockets and scouring the internet trying to find information about how to start investing in real estate. And the vast majority of us want to do that primarily to create passive income. And the path that most of us choose to do that is usually something that we know a lot about, which is single family investing. And we know it because we've all lived in an apartment. Most of us have bought or owned a home or rented a home. And so we feel a certain level of comfort in investing in that asset because we feel like we know it. And so that's how we get started. Most of us, though, quickly find out that being an investor and a landlord are two very different things. And when you start off in single family investing, what you usually do is create another job for yourself, which is not what most people had originally intended when they had this idea of passive income and passive investing. You know, most of us had this romantic idea of sitting on the beach, with our laptop and managing our real estate empire while we're living wherever we want to live around the world. And that is possible, but most of us do not know how to get there. So hopefully tonight we'll share a little bit of a different path for you to follow that would allow you to still potentially build up that type of passive income that we all dream about and create the generational wealth that we're all looking for. So with that said, we want to identify a little bit more about passive investing as a limited partner in a multifamily deal. And the reason that most of us never start off in multifamily is that we just can't imagine how to do it. We don't know what we don't know. We don't know how we could possibly afford to buy $1 million property versus an $80,000 single family investment property, or even a $2 million or $20 million property. And the way we do it is a thing called syndication, which many people are not aware of and do not know what it means. But basically, very simply, it just means that you pool your money with other investors. And by doing so, you can afford to take down a much larger asset like an apartment complex. So you basically get together with friends and family and other investors and go out and buy a large apartment complex. And excuse me. In doing so, there are generally two classes of investors in a syndication or a partnership. You've got your general partners and your limited partners. And where most of us had dreamed about being is on the limited partner side, because that is a passive position where you put your money to work and not you to work. And if you're on the general partner side of the business, it is an active job. Just like the single family piece, you are creating another job for yourself. So especially if you're a busy professional and still working a W-2, then it becomes very, very difficult to be on the general partner side, unless you're the type of workaholic that likes working 80 hours a week or more. And I know there's a lot of you out there, a lot of you on this call tonight, probably. So a little bit more about real estate as an asset class and why invest in real estate versus investing, say, for instance, in the stock market or mutual funds or some of the other things that are available to you as an investor. One of the things that you quickly find out in the investing world is that most people that become very, very wealthy, what we call high net worth individuals or even ultra high net worth individuals, eventually, no matter where they made their initial millions, wind up putting a lot of their money, if not most of their money, into real estate. And there are more millionaires made in real estate than any other investment vehicle or investment class that is out there. And the returns over the last 40 years, we'll show you a slide here in a moment, for multifamily real estate in particular, but all real estate in general, has outpaced the stock market very consistently over time. And one of the things that is driving that, particularly in the last 10 or 15 years, has been very, very favorable interest rates, which, as you probably have heard or are aware of, that one of the advantages to real estate is that you compound your earnings because you are borrowing or leveraging money. So every $100 that you invest turns into $1,000 by using leverage. And so you're earning interest not on the $100 that you invested, but on the $1,000 that you borrowed. And right now we're in a boom for the apartment industry. For the last 10 years, we've seen a big shift in both millennials and baby boomers into apartments and away from owning single family homes. There's many different factors that is driving that, but it's something that if you're an apartment investor, either as a GP, general partner, or LP, limited partner, we're taking advantage of. And the demand for apartments for the next 10, 15, 20 years still looks extremely favorable. If you look out over a period of time, we're still projecting a shortage of apartments for probably the next 15 to 20 years. And you see this factor here, we've had a decline in home ownership from 69, almost 70% in 2004 to 64% approximately today. So why invest in real estate? Well, several reasons is that you'd want to invest is that real estate pays you in many different ways. So if you buy a stock, you're really only buying one type of benefit, which is an appreciation play. So you buy a stock at $1, you hope it goes to $5. And so it's strictly an appreciation play. And of course, real estate also has that appreciation play. But it's one of the things that as real estate investors, we typically put very low on our list of reasons to invest, where in the stock market, it's really the only reason to invest. But one of the big benefits to real estate is net spendable cash flow. What do we mean by that? Sometimes you'll hear it referred to as cash on cash return. And it's typically paid out to the limited partners on either a yearly, quarterly, or even monthly basis. And it's a return on your investment in the form of the collected rents from the asset. So that's one of the additional ways to be paid in real estate. Another is that real estate is a tax advantage investment. So many of us, if not most of us, have a 401k or an IRA that we use because of the tax advantages that they offer us in our investing. And it's a way for us to reduce our net or our gross income to a much lower dollar amount. And nothing does that really better than real estate. You can make many arguments that real estate, because of some of the favored benefits, is the most tax advantage way to invest your dollars. So I'll give you an example. In the last CARES Act, or the last tax package that was put together during the Trump administration, we had a thing called bonus depreciation. If you're not aware of it, basically we use what's called a CapEx study to try to determine what can be written off faster. As most of you know, you get a benefit from your single family home. So you can take that benefit and really supercharge it. And instead of trying to amortize your tax benefits over 27 years, you can reclassify many of those things and take that over a much shorter period of time, often as little as 5 years. And with bonus depreciation, most of that can be captured in the first year. And so you can take what might normally be a $20,000 tax benefit over, say, a 5-year time frame and accelerate most of that into the first year. So potentially as much as $75,000 on a $100,000 investment. So you can see that instead of getting, say, a 25% tax advantage on your total income, that you could potentially write off, say, $75,000 for a much, much larger tax write-off. And so real estate also, because of appreciation, is a hedge against inflation. And we already talked about profiting from appreciation, and we also discussed you can leverage your money. So apartments, we kind of went into this a little bit, but apartments is probably one of the most stable asset classes that you can invest in. Definitely more so than single family. We've seen a huge hit, especially in some high growth markets during the last recession. Las Vegas comes to mind, where if you had invested in real estate, single family real estate in Las Vegas during the last recession, you probably saw as much as a 65% decrease in the value of your asset, where multifamily barely saw a slowing down of the appreciation of the asset class. In most of the primary markets, particularly in some of the hotter multifamily markets like Texas, we saw a flattening of apartment values for probably no more than 8 to 9 months before they started increasing again. And so historically, the only thing that would even come close to the stability of this asset class is probably treasury notes and potentially bonds. But most other asset classes have higher risk than multifamily apartments. So this is just a graph that kind of shows you the population in the prime 20 to 34 year old renter nation, if you will, and how it's grown over the years. And you can see it's just been a very steady increase of renters through the period from 2000, actually starting back in 1999 would have been where it was at its lowest, and been a steady increase since then. So basically a 20-year increase. So we talked a little bit about cash on cash returns. And those we had talked about could be yearly, quarterly, or even monthly, depending on who your sponsor is and how they've set up the private placement memorandum. And the equity or profit that will be distributed also when the complex is sold. So in addition to your cash on cash returns, when the distribution or sale of the apartment complex, once you've completed your business plan, which is typically in today's age, a 5 to 7 year business plan. So when that property is sold, you have your equity splits in addition to your cash flow. So these are generally anywhere from a 70% for the limited partners to as much as 80% of that profit going back to the limited partners. Whoops. So here's a little bit of a comparison for single family versus apartment and some of the advantages that apartments have. So in income potential, you have a higher income potential apartment if for no other reason than you're dealing in a much larger asset that has a lot more stability. And income source, if you're talking about where your money comes from, if you have a renter in your single family home, it's coming from one person, where in an apartment building, if you have a 100-unit apartment building, you've got 100 different sources of income. So if someone leaves and doesn't renew their lease, you're still at 99% on that 100-unit asset, where the single family home, it's now setting at 0. And also from a tenant care and maintenance standpoint, you find that it's much easier to manage that tenant maintenance issues in an apartment complex, because typically you have a dedicated maintenance person on staff that lives at the property or is on the property every single day. And so you as an owner, really it's very, very hands-off. If you're a limited partner, it's 100% hands-off. We talked about turnover, and again, as it relates particularly to how long someone stays in an asset. One of the things you find in apartment renters and dwellers, they tend to be apartment owners for a very long period of time, particularly in asset classes that we deal in, which is workforce housing. The vast majority of them are apartment owners, they're not homeowners. And when you are dealing with rental, single family home rentals, typically they are not permanent renters. They're typically trying to find their way into their own single family home. So again, we talked in vacancy rate, we talked about When you have someone move out of your single family house, you're 100% vacant as opposed to the apartment complex. Maintenance costs are lower because you have economies of scale in an apartment building. You've got one roof covering 100 different apartments instead of one roof covering one unit. And financing is very, very favorable toward apartment buildings as opposed to buying a single family home as an investor. So typically, the only way to qualify to buy a single family home as an investor is using your own debt to income ratio and your own credit score and your own financials. Where with an apartment complex, you have this magic thing called non-recourse lending through agency debt. And you don't really have to know what that means as a limited partner or as a passive investor. But basically, in a nutshell, it's very favorable in regard to the rates, the terms that you receive in order to finance these larger assets, and allows you to not be limited to only owning 4 or 10 single family homes. There is no limit when you're buying apartments. You can own 100, you can own 1,000, you can own 10,000. And it's not based upon your personal income. It's based upon the apartment, which is evaluated as a business. And the loan is made to the apartment as if it were a business. So they're loaning to the business income of the apartment complex, not to you, the individual investor. So here's a slide that came from, I think, Marcus and Millichap that compares commercial real estate to the S&P 500 over a 20-year cycle using a $1 million investment. And you can see that not only has it greatly outperformed the S&P 500 over a long period of time, you can see here in 2008 during the crash, and everyone knows how steep that was and how much it hurt. It's kind of hard on a 20-year to see how steep it is, but you can see it took us all the way back here to 2002. So it wiped out all the gains over basically a 10-year period of time. So all the gains that you had over that period of time, you went back almost starting back a decade and had to start over again. And so during that same time frame, you can see here all asset classes of commercial real estate barely seen a hiccup. And this chart, I was looking for the one that breaks out all the different commercial real estate pieces, because this includes industrial, hotel, retail, and multifamily, all kind of lumped together. And if I had the slide, it would show you that multifamily was the highest performing of all the commercial assets in that space. So it's even better than this chart here. So profiting through appreciation, I probably want to change the name of that slide, because we're going to profit from something that's called forced appreciation, not just market appreciation. So market appreciation, we really don't have much control over. That's your stock market. You're investing in something, hoping that it's a Google and not an Eastern Airlines. You're hoping that it's a Facebook and not a what was the one that they put out of business? Well, I'm not going to recall. If anyone remembers,
MySpace.
MySpace. There you go. You're hoping it's a Facebook and not a MySpace. But in apartments, we don't need to rely on just market appreciation. So what is forced appreciation? So forced appreciation is buying what we call a value add asset. A value add asset can be something that is being mismanaged. It can be something that we've allowed to become old and dated and isn't as pretty or attractive to our tenant base. And we can come in and do things to the property. We can paint the property. We can add landscaping. We can come in and add a dog park. We can add a playground for the children. We can take an old um, um, piece of the property that's no longer really popular in today's marketplace. So I'm trying to think of something off the top of my head, but maybe a bunch of old park style benches with charcoal grills, and get rid of those and make a really beautiful meeting space with gas grills and a fire pit and a pergola, and make something that's a lot more attractive to the tenant base. And by doing these types of things, we can increase the value of the asset. And by increasing the value of the asset, we drive rents up. So if you imagine we buy an asset that the current owner has owned for 20 years and basically done nothing to it for 20 years. We come in, we make it a beautiful new building, we upgrade the interiors, we get rid of the old green appliances and green toilets, and we put in maybe some beautiful um, uh, black appliances, all new LED lighting, and upgrade the old shag carpeting to some beautiful laminate or vinyl wood plank type of flooring. And by doing so, we can raise rents from, let's say, $700 to $850. And as we start to implement that type of business plan, then we are having a massive impact on what's known as our net operating income, or NOI. And at the same time, when we're changing out a lot of these old fixtures, a 3-gallon flush to a 1-gallon flush, an old incandescent light to an LED light, we're also decreasing our expenses on the property. And by combining those two things, we drive up the value of the asset. And we put together what's known as a pro forma for our limited partners. And that pro forma includes a business plan that's typically, as I stated, a 5 to 7 year business plan. And we start exercising and managing that business plan. And as soon as we obtain it, so let's say, for instance, we've put together a business plan that has a 2x equity multiple. And as a passive investor, basically what that means to you is that we want to double your money. So we want to 2x your money. And when we've done that, we've exercised our promise to you, or our pro forma in that business plan. And we've projected it out to be between 5 and 7 years. But if we meet that business plan in an accelerated fashion, say in 3 years or in 4 years, then typically we'll go back to our limited partners and say, hey, we've exercised the business plan, and now we're ready to sell and take our profits off the table, if you will. So a little bit about the tax advantages. We've already talked about accelerated depreciation, and we had talked about that being part of the new tax law, and hopefully is with us for a while. We also have opportunity zones as an addition to 1031 exchanges. So those are just additional ways for you to move your capital from one investment to another investment, and avoid paying taxes on those gains. Okay, and the only thing we really didn't talk about on this slide is different ways to invest. So you can invest with money that's liquid, whether that's in your savings or in a CD, or that you dispose of stocks and move it into real estate. But you can also invest using retirement funds. So you can invest with your 401k and with your IRA if you have a self-directed 401k or self-directed IRA. There are some huge advantages to using a 401k, a solo 401k, self-directed 401k versus an IRA. So that's something you definitely want to talk to your sponsors about, but more importantly, probably speak to your CPAs. And just so you know, we just found out this week that 30% of all company 401ks have an in-service distribution right. So what that means is if you have a W-2 job, you can ask your 401k administrator at work if you have in-service distributions, which would allow you to move money even though you may not be 59 and a half. You can move your money out of the 401k into a self-directed solo 401k without penalty. And so that's something you definitely want to check into at your employer. 70% of you are not going to be able to get it, but 30% is a much bigger number than what I had even anticipated. So something to check into. So a passive investor's checklist. Like any investment, you want to do your due diligence. One of the things that we find as apartment investors and as general partners looking for limited partners to invest alongside us as passive investors is that our passive investors are much, much more sophisticated investors than a typical stock market investor. I don't know why for certain. I like to think it's because our general partners do a much better job of educating our limited partners. And so they know to do their own due diligence in a much more professional fashion than we typically do when we invest in a stock or in a mutual fund. Typically, we invest in a stock because we love Google. We use it every day, so we decide to go buy it. We hear that Bitcoin is the hottest new thing, so we decide to go buy it. Our friend just bought stock in Amazon and says he's doing great, so we decided to buy it. And that's about the limit of most of our due diligence. And once we buy it, we rarely, if ever, check back in on it. We just buy it and hold it. And that's how most of us invest, whether it's our active investments or whether it's through our 401k. We are not very diligent when it comes to investigating and holding accountable the companies that we invest in the stock market. I don't know why that is, but with limited partners in real estate, typically we get a lot more questions. We get a lot more due diligence from our limited partners. And so we put together a little checklist for some of the things that we're typically asked about. And if we're not asked about, the things that you should potentially be asking about. So one of those is market indicators. In other words, why would I want to invest here? Why did you choose this market? And why do you think it's going to be a good place for me to invest my money? What is your business plan? Is it a value add business plan? Is it a yield play? So if your business plan, we typically look for a balanced business plan between yield and value add. So I'll give you an example of a pure yield play. It might have a very low internal rate of return, but it has a very high cash on cash return. What does that mean to you as an investor? That is a very stable property that is yielding a good cash on cash return. It's paying you back a good dividend, if you will, on a monthly, quarterly, or yearly basis. But the investment itself is pretty much a turnkey investment. There's not a lot of room for you to add value. Say, for instance, in that earlier example we gave with a heavy value add with a 20-year-old property that had a lot of room for improvements. So that would be a yield play. Its direct opposite would be a heavy value add play, which we already talked a little bit about. Buying that 20-year-old property, doing a lot of upgrades, and then being able to massively push rent. But in those instances, most of your money is going back into that value add, and the biggest portion of your return, of your gain, is generally at least half of it, if not more than half of it, comes at the sale when we've exercised the business plan. So we try to find a blend of those two, so you have a nice return, but also a nice big piece of equity when we sell. So lender and financials, you just want to ask about the loan that's being placed on the property in order to buy it. There's a lot of different loan products out there for multifamily investors. You will have some both GPs, general partners, and limited partners that like certain types of investment vehicles over others. But the reality is there's really not uh, a a checklist of which one is better. I'll give you an example. Most people are aware of hard money loans if they have any interest in being an investor or limited partner. And we talked a lot about the agency debt and how favorable that is. But agency debt is for stabilized properties. It is very, very favorable financing for stabilized properties. But if you have a heavy value add property that for whatever reason is having a lot of problems, let's say right now in particular, there's a lot of apartment buildings where we have a lot of people that have lost their jobs due to COVID. And they are on what is known as a CDC exemption and are not able to pay their rent. And they're looking for help in trying to pay their rent. So there's apartment owners out there right now that are not able to make their mortgage payments and they're falling further and further behind. So there's going to be some assets that come on the market that cannot be purchased with agency debt, with favorable debt. The only way it's going to be able to be purchased is through a hard money loan because the vacancy is going to be so high and the property is going to be so old and it needs so much value add. So does that mean that's a bad loan? Well, absolutely not. There's probably a lot more upside with a lot more potential gain on that property than on the stabilized property. But by the very nature of the property, there's a lot more work to be done. So along with those bigger returns also comes bigger risk. But that doesn't mean that that's a bad loan or a bad deal. It's just meant for a different investor. So those are one of the things you need to check in your due diligence in deciding on what you want to invest in, the type of investor you want to be. The GP will generally cover the inspections and the appraisals on the property and disclose those to you. The financials will generally go over who they have chosen for property management. And that's a big, big, big deal because one of the advantages to investing in apartments as a limited partner is that not only do you not have to be a landlord or a property manager, but we as general partners also find professional third-party property managers. These are large companies that go through specialized training and are continually updating that training to specific apartment building managers. And you don't get that investing in smaller, really small apartment buildings, and especially not in single family. If you do get a third-party property manager as a single family investor, typically it's just going to be a local realtor. We talked about dividends, cash on cash returns. Typically, you're going to want to know about the sponsor, the sponsorship team, and their track record. You know, what else do they own? You know, and what does that look like? They'll go over the strengths and weaknesses of the deals and how they're projecting that business plan. And they'll also talk about the depreciation and your K1s. K1 is just basically the tax form that you get at the end of the year, you know, saying how much money you made and how much depreciation you can take. And we had a slide in here. Do you reinvest at time of disposition to offset capital gains? So you can do that if you're in an OZ project or if you're in a 1031 joint venture project. So that's something that you definitely want to ask your other investors about. Communication. I think that that's probably one of the most underserved pieces for passive investors and limited partners. And one of the things that you can rest assured, if you have a sponsor that's part of the GOB network, it's one of the things that we not only all are dedicated to, it's part of our ethos, it's part of our vision statement, it's part of our mission statement, is making sure that we have a set of best practices that includes taking care of our limited partners. we are trying to put together a set of standardized practices for operating agreements, for PPMs, and we're trying to put together a Magna Carta, if you will, or a Bill of Rights for limited partners, so that you know some of these things we are dedicated to making sure we all live up to a standard that, quite frankly, is missing in a lot of these deals. And so that's one of the things that you definitely want to ask: how are we going to be communicated with? How often are we going to be communicated with? And hopefully that will be in the pitch deck in writing, so that you can hold them accountable for that. Voting rights as an LP is definitely something that you can ask about. Extremely rare in the industry, by the way, but something we strive for on the GOP platform. What do we do? Well, we help find, as general partners, the emerging markets, the best places for you to invest, and we give you the whys in the business plan, why this asset, why this market, what we like about it, and typically what you don't see is the hundreds, if not thousands, of deals that we look at, and the hundreds of different markets that we evaluate, trying to find these deals to bring to our limited partners. We are also responsible for not only locating the properties, but underwriting those properties, preparing the business plans for those properties, engaging and interviewing for the different team members that are on the GP, the asset managers, the third-party professionals, whether that's the property managers, our attorneys, our CPAs, and maintenance people. All of those third parties, the GP team is responsible for managing. Also, property inspections and full due diligence, meaning that we typically will want to walk every single apartment in a complex before we will decide to move forward on the deal. Also responsible for negotiating the contracts, and also for finding and negotiating with our lenders, and ultimately managing the asset as the asset managers. Also liquidating the property when it's time to sell, after we've exercised the business plan, and then offering our limited partners the opportunity to reinvest with us moving forward into our next deal. And we're typically looking for C and B class properties, but we're typically looking for that in B and A areas. And one of the benefits of investing with us, and I say us, meaning the GOB network of apartment investors, general partners that are part of that GOB network team. We offer a strong track record on many investments. We'll have a pref or a preferred cash flow, which basically just means that our limited partners get paid first, and they get paid 100% of all of the money that apartment generates until they reach a preferred return. So typically right now in the marketplace, that's anywhere from most deals right now are 7 to 8%. On some higher, real high yield plays, you might find some that are at 9, but those are the typical pref returns. Higher returns than most investments. Well, I think that goes without saying. We've kind of beat that into the ground. Steady communication, reiterated, very transparent. One of the pieces to being a member of the GOB network, as either an LP or a GP, but especially for the general partners, is that we strive to be extremely transparent with our partners, whether that's our key principals or whether it's our joint venture partners or whether it's with our limited partners, our passive investors. And I can tell you from being a passive investor for many, many years, transparency does not exist. You can see that in the pitch decks, but more importantly, you can see it once you've invested in deals, and you see how limited the information is that you receive on a month-to-month basis. If you're very, very lucky, on a month-to-month basis. Um, we strive, well, we don't strive, we are 100% SEC compliant. But one of the things that we do strive to do is to remain on the very forefront of that. There's a lot of new things that are coming out this year with the SEC, a lot of things that might make investing even more fun. I'm extremely excited about some of the new changes to the accreditation piece of what does it mean to be an accredited investor. We're moving more toward the 506B model for accredited investors, meaning that there's going to be the ability to self-certify. And that's very, very exciting for you that know the difference between accredited and non-accredited. We'll go into that in just a moment, possibly. We already talked about A, B, and C asset classes. We already talked about managing the assets and the exit strategy. The only thing that I want to cover here is that we want to make sure that we have multiple exit strategies. We don't want to rely on just appreciation as our only, okay, we're going to wait till it appreciates to $5 million and then we're going to sell. So we kind of went over that with a lot of the things that we build into the business plan. But we can exit either through a sale. We could exit. We could have a buy and hold strategy if we're in a downturn. When our business plan reaches that 5-year mark, there's lots of different things that you can do to build some pivot points into your business plan. And those are things that you want to ask your sponsor about. Okay. Basically just saying what happens when we sell. We're going to be, as the asset managers in your general partner team, responsible for selecting a buyer, negotiating the contracts, and then of course, making sure that you get your payouts and having the opportunity to either 1031 or to move with us into a newer and hopefully even higher value asset. So speaking to the accredited investor piece here, I think we'll hold that. I think most people are familiar with it, but if you're not, please ask that in the Q&A piece, the difference between accredited and sophisticated. And that's all we have. You can find the GOB network if you're interested in partnering with any of our GPs at thegobnetwork.com. You can also find, if you know someone who is on the GOB Facebook page, you can reach out to them there. We also have a LinkedIn GOB page that you have to request membership into. But if you want to find all of or many of the people that are active on the GOB, you can use the hashtag GOB Network. Is also another easy way to find them across most other social media. And with that, Mark, I'll turn it back over to you. I'll stop screen sharing, and if I can find my stop share.
Awesome, Jim. Thank you so much for such a vast knowledge of information. And I'm sure a lot of people on my social media have gotten a lot of knowledge from this. So we will open it up for Q&A since we're at the top of the, almost at the top of the hour. I do have one question for you. How active are LPs in a deal when you bring them on?
So you can have as much as, I'm going to say 2 hours a month involvement, or as little as 0 involvement per month, as far as a time commitment for you. Because really, as a limited partner, the only thing you're doing, you're putting your trust in a deal that you like, in a market that you like, and a general partnership that you like. And those are not necessarily in the right order. I would argue that the general partners that you invest in is probably the most important piece, and their commitments to you. But I typically will want to see a little newsletter kind of giving me an update each month about my asset that I'm invested in. Kind of where we are on the business plan, And it might say what our vacancy rates are, and that we are in the middle of putting in the new barbecue, and just give you a basic update. And it could include, some market information, but it's usually just maybe a paragraph or two, and only takes you a minute or two to read. And then what we want to see is a much more detailed financial update. So if you're the type of person that loves to dig into the numbers, then this would be your opportunity to sit down for 2 hours on a Saturday with a cup of coffee and really dig into the financials and see what the occupancy rate is, see what the bad debt ratios look like, see what the expense ratios look like, see where the money's being spent, see what pre-lease, what the advertising budget looks like, all of those different things that you'll want to look for, in an expense statement. And so that might take you a couple hours a month if you're the type of person that likes to dig really deep into the numbers. So I don't know if that was what you were asking, or if you were asking more not of the time commitment, but how much involvement they have as far as decision making, or could you?
Sure. I should have added that part. So I'm leaning towards more so how active as far as decision making, as you just mentioned, and involvement in the structure of the deal, because I think a lot of people think that LPs are actively, they have sort of what a say so into the day-to-day mechanics of the investment. So how does that work?
So large apartment buildings, I would say almost exclusively are purchased using syndications. And the vast majority of the people, anywhere from 70 to 30% of the people involved in the deal, they own that much of the deal, but they are buying an asset manager, a sponsor, a general partner to manage that for them. And the operating agreement and that private placement memorandum give the sponsor who found the deal, who's doing all of the work on the deal, all of the decision-making power. So typically you have absolutely no input into the day-to-day decision-making on that deal. Now, the only caveat to that might be is if you have a deal that is doing very, very poorly, which would be honestly a rare thing. But if you did and had a very poor asset manager, then potentially you have the voting rights to have that person removed and replaced with a different asset manager. And that asset manager has the same power to do that for the property manager, but also for all the other pieces that are in the operations. So now the only other way you could potentially buy a large apartment complex would be using what's known as a JV or joint venture type of structure, or a limited partnership where everyone is a limited partner. It's limited partner is used in a slightly different terminology when you're all limited partners, because it's really more closely resembles a joint venture where each of you have a deciding vote based upon how much you invest. So it's what's known as a pro rata share. So if you own 10% of the shares, you get 10% of the vote. And the reason most structures are not put together like that, as you know, it's like playing that whisper game when you're a kid, where you've got 10 people in a circle and you whisper something into their ear, and they whisper it into the next person's ear, and by the time it comes back to you, it doesn't sound anything like what you had told them. It's like herding cats trying to make a decision just what color you want to paint the outside of the building. So that's why we don't generally see very many large apartment complexes purchased that way.
Understood. Okay. Thank you for answering that. If anyone else have any questions at the moment, this is the time to shoot your shot and ask your questions.
Hey, Jim, this is Nick. So what is the minimum amount that one can invest into this?
So I'm glad you asked that, Nick, because there is no standard answer for that. When I first started investing in apartment buildings um, right after the last downturn, it was very, very easy for me to find syndications that I could get into for $10,000 investment. But almost every 6 months, that number kept moving up. And it moved from 10 to 12 to 15 to 20 to 25 to 30, 35, then it jumped to 40, then jumped to 50, then it jumped to 75. And now it's very normal for me to see a lot of syndications at 100 grand to get into the investment. We have been pushing very hard on the GOB network to encourage some lower minimums so that it makes it easier for more investors to invest. And that's one of the reasons we're really excited about some of the new things coming down the pike. There's this thing called a 506 CF, and the CF stands for crowdfunding. It's been around for quite a while, but it really wasn't very applicable to the apartment space because it had a $1 million maximum dollar amount. And you just can't buy a lot of apartment buildings for $1 million. And so they recently raised it. I believe it already passed the middle of last month to $5 million. And so now you can start to find, particularly in some of the secondary and tertiary markets, you can start to find some 100-unit apartment buildings in that $5 million price range. And even in a major market like Chicago, you might be able to find, a 20-unit apartment building in that price range. And so with the CF, you can have much lower minimums.
Okay. And one other question, Jim. Would people, do you have experience where people with Visa has also invested in such deals?
In REITs?
No. So I am not a citizen of the United States. I'm here on visa.
Yeah.
So is it possible for a person on visa to invest on these things?
It is, although there's a lot more hoops for you to jump through. The easiest way to do that is find what we commonly call a capital raiser, a person whose primary job is to raise capital. And there's many of them that have specifically put together special vehicles for foreign investors to invest in. So if that's something that you're interested in, you'd want to reach out. I would encourage you to maybe join the GOB Facebook group if you're not a member of it, and
okay.
And say to the people that are out there, look, I'm a foreign investor and I'd like to invest, or at least investigate how I might be able to investigate investing in apartment buildings. But
okay.
Basically, do you own a business here in the States?
No, I actually work in IT.
Okay, all right.
Yeah.
So that's one of the easiest ways, by the way, is to maybe open a small consulting business. If you want to be a lot more involved, open a small consulting business, open an LLC, and open a bank account for that LLC. And now you've got a legal U.S. entity with a legal U.S. bank. There's still a few more things that you have to do, and you definitely want to do this under the advice of an attorney, or you want to do it through somebody, a capital raiser who's already used an attorney to set all these things up. So that's basically the two different ways, two different avenues that you can follow.
Okay, thank you.
So I do have another question for you, Jim. What are the common fees, and how does the GP make their money when the deal is structured?
So if you're a general partner, typically there's many different fees that can be on a syndication. And one of those is the asset management fee. So we talked about what it takes to actually underwrite a market, find a market. Kind of some of the things we left out is the frequent flyer miles that you have, because you're flying to typically a lot of different cities and meeting with Chamber of Commerce, meeting with local officials. meeting with local investors, touring properties, maybe even having a sit down with not only the Chamber of Commerce, but the local Economic Development Committee, a lot of those types of things before you can even find a market that you really want to invest in. Hours and hours and hours of reading journals, trying to find, places where, maybe some of the top 100 corporations are moving to and why they're moving. Do they have contracts in place? Those are all things that you need to dig into to determine a great market. And so your asset management fee helps offset all of those costs for the general partner. And I didn't even go into, all the hours of underwriting and, the tools and resources that you need to do all those things. So asset management fees help cover that. There can also be acquisition fees, meaning that you do the same kind of legwork and relationship building for brokers on both the asset side and on the lending side. And it can be a fairly in-depth, complicated piece, depending on how complicated the capital stack is. And when I mean the capital stack, most often when you buy a home, there's only two pieces to the capital stack: your down payment and the bank. But when you're buying a large apartment complex, there can be many, many different pieces to that capital stack. There can be an agency lender. Sometimes we talked about a hard money lender. There can be private equity. There can be mezzanine debt, bridge debt. There can be first and second positions. So there's a lot of different pieces. And if it's a really complicated capital stack, you'll usually see an acquisition fee that goes along with that. There can be a disposition fee. It's something that we typically, as the GOB network, we try to build our deals in such a way that we want to minimize the fees. And so we typically don't see very many disposition fees on our deals.
Okay. I have a few questions that I'm pretty sure inquiring minds on my platform might want to ask. So if anyone has any questions, feel free to ask, or else I'll just keep shooting a lot of questions at Jim. But in the interim, how is the deal structured in terms of profit sharing with the LP and the GP?
Could you ask me a slightly different way, Mark?
Sure. So how?
Sure I understand what you're asking.
So how do when the operator gets a deal and they speak with investors, how does the operator structure that deal?
Oh, okay. Yeah. So are we talking about the splits, the typical splits? Okay.
Between the LP
between the LPs and the GPs. So you can see equity splits all over the map. And I think that it's very normal to see a 70-30 split where the GP general partners are getting 30% of the equity or profits, and the limited partners are getting 70% of the profits. There are some deals where the limited partners could get as much as 80% of the profits. But a lot of times those are deals that what we generally see is that the more certainty of the deal, the lower risk of the deal, typically the splits will be more balanced. So you can find deals that have a 50-50 split. You can find deals that is 60%, particularly on really heavy value add deals or even new construction. You can see deals where it may start off 100% for the limited partners until they reach a hurdle. And let's say that hurdle is 8%. Once we've returned 8% return on investment to the investors, then the sponsorship team would start to get a higher and higher and higher percentage. So it really depends on the deal. What you see on the GOB network, almost all of our splits are somewhere between 70 and 80% going to the limited partners.
Okay.
And many times 100% because they have a pref. So that's something that you need to be aware of. If there's a pref, 100% of the profit goes to the limited partners until you reach that pref or that hurdle, 100%.
Now, have you come across where investors on the LP side require for GPs to have skin in the game? And is that something that is mandatory?
Yeah, so it's absolutely not mandatory anywhere, but most of the lenders that you're getting the preferred debt from do make it mandatory. In other words, there's nowhere written in their bylaws that you have to, but right now, I don't know any lender that's going to loan you money if you don't have skin in the game as a general partnership. Now, a general partnership, I don't want to, I want to make sure that I clarify. It's not generally, it's not one person. Generally, it's anywhere from 3 to 5 people on a general partnership team because a GP typically has to have many different moving parts. We talked about 2 of them already, the asset manager and the capital raiser. So those are 2 of the very, very integral parts. But we also have an acquisitions team. We have the underwriting team. We've got to have boots on the ground. We want people in every local market where we're investing. So there's a lot of moving parts on that GP side of the team. Did I answer the question, Mark, or was there?
Yes, you did.
Okay.
These are questions for inquiring minds, by the way.
Yeah.
So another question I do have for those who may not know, what happens if you can't make the projected cash flow? Worst case scenario. How is it handled?
Yeah, so one thing that you have to know, and it's clearly defined in your PPM, there's with any investment risk. And with that risk, you can lose all your money. So what does that look like? Well, let's compare a stock and an apartment complex. So if you're investing in a new startup in the Silicon Valley or in any new startup business, every one of us knows that new startups, typically 90% of them go out of business in the first year. So if you're investing in small assets like that, then there's a 90% chance you're going to lose your money. If you're investing in very old companies that are maybe in the Fortune 500 or the Fortune 100 or the Fortune 50, then you have a much better chance of not losing all of that money. Because how many times do you hear of a really large corporation going out of business? It's not like a new company. But still, even there, all of us can think about an industry. Think about the automobile industry. 50 years ago, almost 100% of all the cars sold in America were sold by Ford, General Motors, and Chrysler. Today, the big 3 combined don't even make up 30% of the total car market. So they've lost like 70% of their customer base. Think of the airline industry. How many airlines in your lifetime have gone out of business? Trump Air, was it JetBlue, Eastern Airlines, Continental Airlines, Trans World Airlines. I mean, just these are big, big, big companies that just completely gone. Think of the steel industry. There used to be literally hundreds and hundreds of steel mills in this country providing steel for this country. Today, there's only 2 integrated steel companies in America. Only 2. And only one of them is US owned. So in that regard, think of real estate. You bought an apartment building. Can you lose all your money? Absolutely. But what is the likelihood you're going to lose all of your money? It's an apartment building. Nobody's going to pick it up and put it on a trailer and carry it away. People are living there. As long as people are living there, then it's always going to have value. And there's governmental agencies that are trying to put rules in place to make sure that not only is it there, but it's there and you're taking good care of it. They don't allow you to let the grass grow to 12 inches. They don't allow you to leave a broken window broken. So there's a lot of things in place to protect your money and protect your asset. So that's why it's one of the most stable and risk adjusted investments that you can possibly make. So is there risk? Absolutely. But I would argue that it's probably one of the absolute lowest risk assets that you could put your money into.
Awesome, awesome. Does anyone else have any questions for Jim at the moment?
Hey, Jim, this is Greg. Jim, thank you so much. That was a great presentation. A lot of valuable information provided. And also thank you for answering the questions thus far. Question for you is, for LPs or anyone interested in being LPs, what would you recommend? What is the most important thing you recommend that they do to qualify a GP to work with?
So there's an old saying in our business that before you can ever get a limited partner to invest with you, they have to know, like, and trust you. And so I will turn that around and say the most important thing for you is to know, like, and trust the sponsor that you're choosing to invest in. I think that's even more important than where it's located. So as an example, DFW, Dallas Fort Worth, is generally considered to be one of the best places to invest as an apartment investor. It's one of the epicenters, the Texas Triangle, kind of the epicenter of a lot of apartment investing. But even if you have one of the best assets in DFW, in one of the best markets, in one of the highest graded neighborhoods in DFW, I would say to you, I would rather you invest with somebody that you already know, like, and trust in your backyard before you invest in that asset in DFW in a great neighborhood with somebody that you really don't know. That's how important I think it is that you pick the sponsor first.
Thank you, Jim.
Do we have any other questions?
Okay, well then, if no one else is asking, let me ask one last question then. For any newbie wanting to become a syndicator, what would you recommend? I haven't had so many years of experience. I haven't seen the ups and downs. I'm sure you've seen some newbies came, some newbies went, and some succeeded, some failed. What is it that you would say, you pinpoint and say, okay, if you do this right here, it will align everything else. It will allow everything else to align.
So I want to start by saying that being a general partner is not easy. It's a full-time job. It's a very hard job. And there's a reason why we say it's a team sport. It's almost impossible to do by yourself. It's like trying to drink from a fire hose. There's so much to know, so much to learn. And one of the reasons why so many people decide to become limited partners or LPs, but I don't want to discourage anyone from doing it. But what I do, the reason I'm setting it up in the way that I am, is that there is a common trait, a common path that most people choose when they're trying to become an investor, particularly when they're trying to become a multifamily investor, an apartment investor. But I see people do the same thing over and over again, make the same mistake when they're trying to learn to wholesale, or they're trying to learn to be a fix and flipper. And that is, they want to be an investor, and they think that they need to go out and pay someone 30 grand, 50 grand, or even 100 grand to teach them how to do it. And while you most certainly can do that, and while I have most certainly done that, not once or twice, or even 4 or 6 times, that I have done it many, many, many times over and over again. And you can learn a lot by finding a mentor and finding a teacher. But I will argue that if you've got that much money to invest in yourself, the very best mentor you can have, the very best teacher that you can have is the asset. Go put your 30 grand or 50 grand into buying an apartment building. And that apartment building will teach you more about how to be a great investor than anyone could ever teach you. I cannot hold a candle in trying to pass knowledge on to you that apartment building will. And when you do a good job, it'll be the best teacher you've ever had. It'll be the most encouraging teacher you've ever had, because every month it'll put a paycheck in your mailbox and pat you on the back and say, attaboy. But even more importantly is when you don't do a good job, it will be relentless in letting you know what you're doing wrong. And it will not stop punishing you until you straighten out what you're doing wrong. It's not going to say, it's not going to throw up its hands and said, well, you know, you can lead a horse to water, but you can't make it drink. And I hear that false narrative over and over from these teaching platforms. So that apartment complex, you will either fix what's wrong or it'll drive you out of the business. And it'll be there 24 hours a day, 365 days a year. And I don't know any mentor that you can call 24 hours a day, 365 days a year. So I would say, do not put your money into that. Put it into an apartment building. But I also recognize that the reason most people are spending that money is they have a lack of knowledge. And that is one of the reasons we started the GOB network, is to provide that knowledge base, the tools, the resources, the partners, and everything that you need to become an apartment investor. And I will tell you that all of the things that I have learned from all the different mentors that I have had are in the GOB network. And the GOB network is a by member only. In other words, you can't get on unless you're invited onto the network by another member. It's a membership site. But the cost to join the GOB network is not 100 grand or 50 grand or 30 grand. The only cost to join the GOB network is that you be a go-giver and that you leave as much as you take from the platform, and that you're an active participant. Because even the people that spend 30 or 50 grand, you would think they've invested so much money that they would be an active participant in their mentoring programs. But 80% of the people that join those programs never buy anything. 80% of them fall out within 2 years. So I would say the very best thing you can do is find a member of the GOB network and see if you can get an invitation to join, because there is no financial cost.
Thank you, Jim. And thanks, Mark, for inviting me.
Greg doesn't need an invitation.
I'm in there.
He should be. You should be very active.
Yeah, I'm in there already. Yes. Yeah, but by the way, is the site back up? I know last week you said there was some issues happening.
Yeah, the website is under construction. We are having some issues with the sign up form, but what was happening, you were signing up, but it looked like you weren't, and so it was making you sign up twice, and then it was saying there was an error. But we were actually getting the information on the back end. So if anyone signs up and it looks like there's any issue, I would just encourage you to take a screenshot of the error message and just report it back to whomever invited you. And if you don't know who to report it back to, feel free to use the contact form that's on the GOB network. Or if you want, you can send it directly to me. I'll also make sure to forward it to the right people.
So one more
Thank you.
question before I close this social media feed and we can have our back talk. Can you expand on cash and internal rate of return for the inquiring minds that have no clue what that is?
So cash on cash is relatively easy to understand. Cash on cash return, if you invest $100,000 and I'm able to provide you a 10% cash on cash return, or some people want to think of it as a dividend, then I would give you back $10,000 on that investment. And if it's a yearly return, which generally that's the way it's presented, then you'd get $10,000 every year. So if we had a 5-year business plan, you'd get $10,000 every year for 5 years. And then when we sold, you would get the balance of your equity at the sale. So if we promised you, for instance, a 2x equity multiple, and we had given you back 50 grand, then at sale, we would give you back 150 grand. So you would get 50 grand of it from the cash on cash, and the balance you would get from the sale. And IRR, if I want to take the easy path out that most everyone does, I would say that IRR is basically deals with the net present value and time value of money. It factors in not only your rate of return, but what time has to do with that. And it basically wants to set the net present value to 0. And it's a calculation that most people use to determine the type of investment. The problem with IRR, it's like the problem with cap rate. There is no one cap rate. There's multiple cap rates. And most people don't know that, and they don't know what the different ones are. There is no one IRR. There's multiple IRRs, and most people don't know what they are. And even just the classic IRR, you cannot base your decision on IRR alone, because on a yield play, you can have a property that's giving you a $10,000 return per year, and and after 5 years it's $50,000, and we'll say it has an IRR of 10. But if I gave you $20,000 in the first year, and then $30,000 spread out over the next 4 years, still the same $50,000, but the IRR will be like 16%. Same money, but it was distributed differently. So that's why there's time value to money. If I take that same scenario and I pay you the $30,000 over the first 4 years and $20,000 in the last year, then the same $50,000 will have a much lower IRR. So most people want to say they have an investing criteria. They want the IRR to be between 12 and 15%. And they want the cash on cash to be between 5 and 8%. And I would argue that a lot of people don't know what they're really saying. They're just repeating back what a lot of other people have said to them, that that's their investing criteria and that's what they want. So for someone that's an elderly person that has tiered CDs and they're living off of that CD income, or they've got 401k that they're taking a distribution from every single year, and they need their own fixed income, and they need the cash on cash return is the most important piece to them. So I would argue for them that waiting for that money and having a lower yearly amount is not in their best interest. They would be better served to have even a more even distribution of the capital, or to get more of the capital in the front end. So the same amount of capital, but distributed a very different way, especially if you're an elderly person on a fixed income, knowing that you can count on $1,000 a month is something that you can build a life around. Where it's going to be $100 one month and another month it might be $3,000, you can't count on that. It's very, very hard for you to build your budget around that kind of income. So IRR can be very, very confusing and very deceiving.
Awesome. Thank you for answering that, Jim. So I'm just going to close out the social media world right now. I want to thank you all, you guys on social media who jumped in and who chimed in with your questions. If feel free to watch the replay. If you have any questions for Jim, feel free to reach out to me and I'll definitely make the connection. Until next time, social media, we are out.
Thanks, Mark.
Thanks, Jim. So I appreciate you guys jumping on. If you guys have any other questions for Jim, feel free to shoot it now. And I'm pretty sure you guys know where to reach Jim, how to reach Jim. He's all across social media every day. So it's, make those connections. As mentioned, next week we will have a special guest. And we will have a special co-host as well who will be running the show. I'll be taking the backseat next week, so feel free to come in. I will be dropping the flyer every day this coming week. So feel free to chime in, bring a guest or two or three. We want to have a packed house. We want to be here, support this surprise guest. They will be, as Jim mentioned earlier, they will be divulging on the secrets of the asset management world. And I, for one, I am looking to hear these secrets. So does anyone else?
Very excited to be hosting next week or co-hosting next week with Mark. So I would really encourage everyone who is an active investor, meaning part of a general partnership, a GP. You definitely do not want to miss next week. And make sure and bring all of your questions in case I don't ask all the right ones or the ones that you really want to know.
Anna, did you have a question?
Oh, I wasn't aware that I was not on mute. But thank you, Jim, for the presentation. My question actually, what is in my mind is going back to the question about that Mark asked, as far as what happens if there is if the projected cash flow cannot be met. And you gave example about the different stock markets and so, but also how the real estate investing is probably one of the safest. I do kind of want to push on that a little bit for trying to understand, because yes, other markets do lose their money, and as an investor, you know that, but when it happens, it really sucks. So you want to be able to know, like, is it, for example, if the cash flow is not able to be met, are you extending the length of the, since you said it's between 5 to 7 years, are you then extending the length of time so that the money can be acquired somehow, or how does that work?
So I thank you very much, Anna, for following up on that question, because I kind of got sidetracked a little bit on it and didn't fully answer it the way I would like to. So I appreciate you following up with it. So there's a lot of different answers to the question, though. So I'll just give the briefest couple, and then if I don't answer it enough, then follow up with me. So there's basically two types of returns for cash on cash or dividends. So we have the pref return, or we have just a straight split. So if you have, say, for instance, $10,000 to divvy up, and we have a pref return of 7% on that 10,000, then I would owe you $700. And then everything after that $700, we would split in, let's just say 70-30, okay? If we didn't make money that month with a pref return, I still owe you that money. So it would carry over. And so next month, if we were just doing it in a linear fashion, if I owed you that same amount of money each month, then it would carry over each month until I made enough money to pay it back to you. So if we had like typically, let's say during this last year with COVID, we had a lot, meaning most syndications suspended payment because they had so much bad debt on their books. And so they didn't have the money to pay, but they still owe you that money. So when things started to improve and they started to get money back, when some of these CARES Act and some of the government programs started helping everyone catch up on their rents, then that money was owed back to the investors. So it continues to carry over if you have a pref return. Now, if you don't have a pref return, then you split whatever the equity is. So it would be just a straight split. So if it's a 70-30, if we made 100 grand this month, 70% of it would go to the LPs and 30% would go to the GPs. And if you had only $10,000 the next month, then 70% of that would go to the LPs and 10% to the GPs. And if you had a month where you lost money, then nobody made any money. So you only made money in the months where you had positive cash flow. And if we were going through an extremely bad recession and we had not been able to reach our business plan. So if we were using that same 2x equity multiple that we had in our pro forma, wanted to pay you a 2x equity multiple, let's just say in 5 years. And we've gone through a really bad, rough time for 3 years, and the economy just went to poop and we made no money. So typically what would happen is at the 5-year mark, we would go to our investors and say, look, we have not met the business plan yet. Do you want to continue for another couple of years and see if we can get you all the way to the business plan? Or here's what we think we can sell the property for right now. We've gotten an appraisal, we've gotten several different broker opinion of value, and we think we can give you a 1.25 equity multiple, meaning you get 100% of your investment back plus another 25% on top of that. So it's not 2x, it's 1.25. But do you guys want to do that? Or do you want to hold on for another couple of years and see, things have started picking back up again? So, we feel confident that if we have another couple of years, we'll be able to meet the business plan. So that's typically how that would work. Does that answer your question?
Yes. And is there, sorry, as you can hear, mommy, just one moment.
That's okay.
Sorry.
That's all right. He's going to be an A personality, probably on the GP side of the team.
Good one,
So
Jim. Good
I
one.
guess
Good one.
He
this is the after party
demands to be
here.
heard.
That
I
was
want
good
him
one,
on the
Jim.
negotiating team.
I was at the party, Mark. You still recording?
Well, this is beneficial information. So I think a lot of people who will be watching the replay will want to know this stuff. I will cancel the recording in at the opportune time.
Hey, you the host, man. I'm just asking, man. Hey, you the host.
Yeah, as long as we're still talking about LP stuff, I think it's good to record. So Leon, did you have any questions?
I think he's satisfied. Thank you. I guess the other question to that is there a prerequisite or so in order to be a pref return versus a split equity? Like, is it certain type of investors, like you have to bring a minimum of this, or I'm not sure what I want to ask.
Yeah,
Because what it sounds like the pref may be safer, but I'm not sure exactly. Again, you would say it depends, but
yeah.
like, is there a, yeah.
So I think that you can get different classes of shares. Most syndications only have two classes of shares, an A and a B. And that A share can have a pref, but it doesn't have to have a pref. And if you're a more conservative investor, you might want a pref, because that kind of gives you like a minimum. You know you're going to get yours before anybody else does. So it's like, instead of buying common stock, you're buying preferred stock. In most syndications, it doesn't cost you any more to get the pref. In other words, whether you're investing 25 grand or 100 grand, you know, in most syndications, you still get the pref. There are syndications which can have several different classes of shares. They may offer an A, a B, a C, and a D share. And some of that can be, we're offering you a pref, but no upside. That would be one share. We'll call it A. And B share would be, we're not offering you a pref, but you're going to get all of the upside of the equity. So potentially you're going to make a lot more money. It's just that your money's probably going to come at the end instead of coming, you know, every quarter. And then you might have another share that's like a higher pref, what we might call a note, where you're not getting any of the depreciation on the property, but you're getting a guaranteed note, and it might be, let's say, at 10%. So why would you do that? Well, number one, if you have a lot of money to invest and you want a guaranteed rate, because typically we're going to have a much higher buy-in. So instead of 25 grand buy-in, it might cost you 100 grand buy-in to get the preferred note. Or if you have a IRA money or 1031 money, we might structure it in such a way that you get a pref note. Because you, especially if you're investing like with an IRA or a 401k, you cannot get depreciation. You cannot get the benefit of depreciation. So it'd make a lot more sense for you to get a pref note than it would be to just invest in a general class share. But all of that is dependent upon the sponsor who puts the deal together, how they decide to structure the deal. And most of them prefer simplicity, because most investors, if they have too many decisions, they don't, it's harder for them to make a decision if you give them too many decisions.
With the K1, are you also getting this depreciation?
As long as you're investing as an LLC or as a person, a real person, then you're getting both the depreciation and the profits. But if you're investing as an entity like a C Corp, then you're not, or an S Corp. But where most people are not getting it is if they're investing with their 401k or their IRA funds, because the money is already cash, it's already tax advantaged. So the IRS doesn't let you take a tax advantage twice. They don't let you double up on the tax advantage. They don't do double coupon day. I think Meyer still lets you do double coupon day, but not the IRS.
Thank you.
Elizabeth, any questions?
No, I think you've answered some of them. it helps me understand actually how the different structuring is done, whether you're getting that money on the back end more or whether you're getting it forward. Because I know some of these deals, they're like, well, we're going to refinance in year 2. And so we'll kick back your investment money, your initial input. Then this has helped me understand how some of these are done a little differently and what I should or should not be looking for depending on what my expectations are.
Yeah, I'm glad you brought up a cash out refi. Refinancing in that 5-year business model has drastic effects on the IRR and also on the cash on cash return, because you're making typically when you're doing that cash out refi, you're going to return or try to return as much of the initial investment to the investor as you can. So that really juices the cash on cash return and the IRR. It can take an IRR from 3 to 30. And the sooner you model the cash out refi, the higher it's going to juice the IRR. So that's something you need to know, because if I have a 5-year business plan with no refinance on it, then it's a much truer way to measure the returns on that investment. So you need to know that any time you have a refi, you're adding additional risk into that asset. Because what happens if I can't refi? What happens if the rates that I modeled are not the same? There's a lot more unknown when there's a refi. And so that's something most investors don't know, and they don't know to ask that or how to look for it in the underwriting. And so it really goes back to the discussion I was having about IRR earlier.
Yeah, that makes sense. It pushes my capital back into my hands to use further or to use elsewhere. But what is it going to do to my confidence in the deal as it moves forward? That really presumes that asset manager can continue with the deal and continue to convert units or whatever, and that their expectations of what's going to happen 5 years down the road or 7 years down the road is actually going to come to be.
Yeah. Yeah, I agree with you, and there is no set answer. Is it a good thing or a bad thing? Do I want it? Do I not want it? Because the advantages are, number one, it does juice the IRR, which I like, as an investor. But I have to realize why it's doing it and how it's mechanically how it happened. And as an investor, I like the idea, typically, of getting my money back sooner so that I can reinvest it somewhere else. But think about that. If this property is doing so well that you're able to do a refi, it really typically means that it's got a pretty steep growth curve. It's usually a more of a value add situation, and sometimes a heavy value add. That's why they're able to get all of that money back to you so soon. Do you really want to take that out and put it into another investment that might not have that stronger returns? I mean, you're kind of in an investment right now that it's a proven investment. Maybe I want to stay there I want to leave all my money in for at least another 12 months. I want to get more of that upside. But it is a much safer bet for you as an investor to take those chips off the table and put them in another. And that's, what do they call that type of investing? You kind of ladder type of investing, where in the stock market, as soon as it doubles, you pull your initial investment out and start over somewhere else. And you just keep doing that, always pulling out your bases. And it spreads your risk out over a much broader investment platform.
Makes sense. Thank you.
Lena, do you have any questions?
Lena, and I hope I'm pronouncing your name right, and Leon have been mighty quiet. Do you guys have anything to ask or chime in on? Mr. International, do you have any questions?
Lawrence, why do they call you Mr. International? Inquiring minds want to know.
Let's talk real quick. Hey Jim, how you doing? Listen, I've been in and out the meeting tonight because I'm at work. But from what I'm hearing, Jim, I'm getting some information. And when I heard that about, I like what you said about the IRR return and refinancing. Never thought about that part, right? And then you said about about a value add and staying in the deal. So I have no questions. I'm just listening. I'm just listening. I have no questions. So I got to focus on
Well,
what I'm doing.
we had a question for you. We wanted to know why everyone calls you Mr. International.
Oh, because of the fact that I had a meeting one time with Tiffany Ward at the meetup, and a gentleman came from New Zealand to the meetup. Never met the guy before. He said he was there for Tiffany, but I said, okay. So then Mark Caesar mostly Aaron, and then Mark Caesar joined in and insist on calling me Mr. International. They asked me to embrace it. I did not embrace it, but I'm embracing it now. I am Mr. International.
Well, there you go. So we're going to have to push your meetup, not so much in the States, but we're going to have to really promote it on all the other continents.
Oh.
Try to every week.
Jim,
don't
join them.
Person.
Jim, don't join them.
Think big.
Jim, don't further advance this.
Listen, if you don't want it, sir, I'll be glad to take it. I like to think big, and I want my reach to be out there. So I don't mind the foreign money coming to my platform. More deals to buy.
I'm just
I'll take the international. I'll take it then. I'll take it. Okay. I'm trying to embrace this. I'm trying to embrace it. Hold on. Listen, I'm gonna put on mute, okay?
Thank you and good night. I want to thank Greg for inviting us. Thank you.
Thanks.
Thank
Great
you
to see you, Anna.
Anna. It was a pleasure as always.
Yeah.
All right, are we ready for after party?
Hey, there you go, Jim. There you go.
Let's cut off this.
Hold on. I don't want Mark to answer though, Aaron. I want his wife to get on camera and give us permission.
She's all right. I'm holding her computer hostage right now. So all
See,
right. Stop.